This is going to be the start of a video on manual trading strategy that I have never seen presented. It's kind of something I've concocted over the years, and I'm going to be doing this while I'm doing the live compatibility tests because I want to test the expert advisors, hopefully in a profit mode. In other words, make some money on these tests and not lose too much. There's going to be some obviously some second takes because of the coding revisions that we need to do to get the programs compatible. But essentially what we want to do is make some money here at the same time. So what I'm going to show you right now, and there's going to be several pauses in this video, so we hope it doesn't get too jerky here. But this first little part, we're going to look at some indicators that I think are interesting that I watch when I'm trying to execute a manual strategy. One of them is tails, what I call tails. You see these long spikes here? That's a tail. Another one here is the timing. We'll see this period of time between 2100 Greenwich and 600 GMT is typically a lull time. We might catch one of these smaller moves, a swing move in the middle of that, but typically the big moves come after 600. I guess that equates with the Frankfurt Open or something, or guys are jumping early. We can see right here at 600 we got the big move. This is when the trading, or when the action actually starts. We're going to look over here, as I mentioned before, there's a unison of these three majors, the British pound, the euro, and the Aussie, in the way they move. Now you can see here the pound has moved up. It actually made a move before the euro. The euro is now moving up, and the Aussie actually moved up with the pound. So we can look for leaders of these three. So we got our start time here when we want to start looking for action. We have leaders and trends. We can trade all these at the same time if we want to, because they all seem to move in unison most of the time. If not, we'll end up with a hedge. We've got some tails we're going to be looking at, and we're going to be looking at other formations like this wedge. You see, when you start getting a wedge here and you come down to this point, something's going to break out. That's when your breakouts usually happen, and that's exactly what happened here. The other things we're looking for is the trend reversals. We just got a reversal on the steps. Let's see if we can show you that here. This is a step, and up, a down, but that down is higher than the previous one. These are steps down. You see, we stepping down here, then we went into a reversal. We started stepping back up. Now, I'm going to explain how this all goes together right now. This part is just explaining the basics. You can see an up move. We can see these spikes here. We can see this. This is what's called a resistance point. If we back off, we can see that this was a horizontal. It's gone up and down, but it hasn't broken over this point, and that's why they're called resistance points. This resistance point has actually been quite extended over the last 2 days. We have another resistance point down here. We saw we came down to that resistance point, and now it's bouncing back up. So there's a really good chance what's going to happen here is it's going to keep bouncing. This is reflective of the uncertainty of the status of the dollar. and I think we've had some good trends or good indicators on the dollar, so uh, we may end up seeing this this trend down on the pound here shortly. But in the meantime, the market doesn't really know. It's just bouncing back and forth in this range. Let's go zoom here again at these tails, and these tails will tell us that too. We've got what this tail did is went up to that resistance point, and we got a sharp tail down, which means a downtrend after. We got another sharp tail down here, which to me tells me that it's gonna actually continue on down past this resistance point when it starts going back down again. It may end up going back up to this spike. I don't know why this rule seems to work, but what typically happens when you get a spike here, some point down the line the market will go back up to that point, and then it'll turn around and go back down. We will see also trend indicators on these spikes when we start seeing a lot of more spikes to the downside than the upside. For instance, we got a long spike down here, we got a long spike here, we got a long spike here. We have no other long up spikes. So the more spikes we have going down tells us that the trend is actually going to end up going down, even though we're in this reversal here. So that's all we're going to talk about right now, as to the basics of what we might call pattern. This is pattern trading versus indicator trading versus some of these other Heinrich Alchi things, which are essentially just a derivation of these moving averages. I have these moving averages in here as a safeguard against the fast trigger on the expert, and I'll explain how that impacts the trading program on that part. But I'm out of time at this point, so here's just the first basics on the well, it's called step and spike pattern trading, and hope you enjoyed this part.